So we're finally going to break down the exact steps of doing your very first commercial real estate deal. For those of you who are watching this and saying, Henry, I'm excited and ready to do my first investment deal, here is the best possible video to watch to break down each and every single step very simply so that by the end of this video, you're like, Henry, I'm ready to do my first deal. Here we go. So if you don't know who I am, my name is Henry Eisenstein and I've been a part of over $450 million worth of real estate transactions and I'm only 28 years old. And yes, I'm going to break down the exact steps to buying your very first commercial real estate deal. And it starts with step number one, which is get incredibly clear with your goals and the type of property you're looking for. The type of goals that I'm talking about here is a time-driven goal, saying by the end of this year, as an example, I'm recording this at the very end of June in 2023. Let's say that by the end of 2023, you want to own your very first commercial real estate deal. So that's going to give you exactly 6 months to go through the entire step-by-step process we're going to break down today. A lot of you could do this faster and some of you might need more time, but let's just say for this specific goal, we're talking about within the next 6 months, buying your very first commercial real estate deal. So that's your first clear goal. The second half of that is getting very specific on what type of property you want to buy. Because it's not just enough to say, hey, I want to buy my first commercial real estate deal in 90 days, 6 months, a year, 10 years, whatever you're going to say. You need to be really specific on the exact type of deal you are looking for. Now, this can be anything from, and I know you're going to say this isn't a commercial deal, a two-family, or a single-family rental, all the way to a 500-unit apartment complex. Regardless of what you're looking for, we're just going to say specifically, you're looking to buy X type of real estate deal. You need to know exactly what that is, what type of interest you have. This way, you can start studying, because point number two is study everything you need to know in order to become a masterful investor for that specific asset class. Because I want to explain something to you. Now that you've set the goal of exactly what the time-driven time frame looks like, right? You have a timeline of exactly when you need to accomplish this goal of buying your first commercial real estate deal. And you've also gotten really clear on what type of deal you're looking for, okay? Exactly what type of asset class. So let's say specifically you're saying, I want to buy a multifamily property. Does not matter what type of asset class, but we're going to say in this instance, a multifamily property. And obviously commercial is dictated as anything above 5 units, 4 units and less is considered residential. In this instance, we're going to say you're going to want to buy a 10-unit apartment complex. Very simplistic deal. What's important to understand here is now you've chosen you want to buy a 10-family apartment complex. Point number two is study apartments and understanding the lingo around that type of asset class. So you know not only where you're going to buy this deal, because you want to be studying the market and you want to study the asset class so you know everything about it. Because you're going to want to know what areas you want to buy in, what type of details you need to be looking for. As an example, you might want to buy deals that are all 2-bedroom units instead of all studios, because that would probably be a benefit to you, right? All larger unit or a good unit mix. You're also going to want to look for apartment complexes that might not have a really choppy layout. You're probably going to want to look for something that actually is one single building, where it's not like 4 families in a 2-family on one lot. You're going to want to look for one large building with 10 apartments in it, with a good unit mix, with larger bedroom counts instead of a bunch of 1-bedrooms and studios. You want to have some 2 beds and maybe 3 bedrooms in there so you can maximize your rents. You're also going to want to know what town has the best rent rates, what town has the highest amount of people looking, the highest demand for rentals. You're going to want to be looking for a specific one where, again, one building, which means one roof, so you're going to have a lot less deferred maintenance that you might have to deal with. Something that has a lot of value add, so you might want to look for something that has some vacancy or has a lot of people individually in the property that does not have rent control on it, but people who are in there who are possibly paying very low rents where you know there's a lot of upside in raising the rents. You're going to want to be looking for a property that has everything separately metered, so the utilities are all separately metered, where all the tenants pay their own electric, they all pay their own heat, and maybe they even pay their own water. That would be fantastic. So you're paying attention to all these things. You want to understand the lingo about your type of asset class that you're looking for. Point number 3 is that now you want to go to town on finding exactly the perfect property. This is all about finding the perfect off-market deal. Can you buy something on the market that still makes sense? Sure. However, it's very rare that you're going to find a very good deal when it's listed on the market. Most often, if you want to find the best investment property, period, they're typically off market, which means you need to be connected with a lot of real estate agents if you're not a real estate agent. And if you are a real estate agent, you need to get very, very good at prospecting for off market deals, sourcing off market deals. So these typically the best deals come from real estate agents, wholesalers, and off-market prospecting and lead generation of sorts, which can be cold calling, investor meetups, mailers, marketing campaigns, you name it, to find a great off-market deal. And the best way that you're going to do this along with that marketing is you can pull lists from Reonomy, CoStar, CREsync, and several other types of softwares, PropStream. There's a bunch of different softwares that you can be downloading. You're going to want to filter by a bunch of different criteria, by the asset class you're looking for, the unit count you're looking for, as an example with multifamily. And now that you pull the list, you're going to want to market to the list. So the next step here is all about finding that great investment deal, which is going to, again, could take you some time, but it's more important to realize that you're going to be prospecting for a lot of opportunities, and you're going to find possibly one of the multitude of people that you're going to finally be connecting with from that list. Because if you pull a list of 1,000 opportunities, you might only find maybe that you get in contact with like 20, 30, 40, or 50 of them, maybe 2 to 5%. And then of the 2 to 5%, probably 80 or 90% of them are probably going to want a higher price for the property, maybe a little bit too much money for it to be a steal of a deal. But you're going to be able to get probably somewhere between 2% and 20% of those people who might give you the property at a decent price. Now that you've gotten clear on your goals for a timeline, you've gotten clear of what asset class you want to specifically look for, you've mastered and understand the lingo of that asset class, and you have now pulled the list and prospected the list, like you hit the list and you finally found the property, the next part about this is going to be finding the right partners. I'm going to say this from two different lenses. One of which is you doing the deal on your own, which is totally fine if you've got the money and you understand how to invest in real estate. However, if you're on the side of the coin where you've never bought a piece of real estate before, maybe you have the money, or maybe you don't. And if you don't even have experience in managing deals like this, it can be incredibly beneficial to do your first deal with a partner. And sometimes you even do it with multiple partners. We all have to have a specific reason for being in the deal. One person can find the deal, another person can fund the deal, and another person can manage the deal, and another person can be the contractor of the group where they're renovating it and doing all the work on the deal. So you have to understand, like, you're gonna want partners here, because having partners allows you to work faster and smarter and make less mistakes. What I've done in my history of doing deals now, where I've done, again, hundreds of millions of dollars worth of real estate transactions, I've found that on the investment side, a lot of people do deals with partners. Even the most successful do deals with partners, funding partners, management partners, you name it. There's always a reason why it can be incredibly beneficial, where you can diversify the risk when you're in a deal with people who are smarter and more experienced than you are. It's very beneficial. Now, again, I'm not saying you can't do it on your own. I've done deals on my own. And I'm not even saying I'm the best investor around, because I'm definitely not the best. I'm okay, and I can do some deals. I have a bandwidth of risk that I'm willing to take personally. Once it gets over that bandwidth of risk, I typically want to have partners. It just makes things a lot easier. And I also have a lot less risk to take on personally, and a lot less headaches that I have to deal with personally. Having the right partners, which can be lender partners, so like people who can help you with getting great financing, having great inspector partners where you're like, again, when you're going to buy a good deal, you're going to want to get it inspected. You're going to want to make sure you're having somebody who you can have come to the property who's actually going to give you a proper inspection and not just BS with you. You're also going to want to have a good contractor who can walk the property with you, has good experience around structural issues. You're going to want to have a management partner who actually understands how to manage a deal properly, and they don't just manage like 7 properties right now. They manage like 700 units or a few hundred units, and they have great experience on how to save you money and also deal with all the headaches you don't want to deal with, so you're not getting phone calls at 11 o'clock at night with a crazy issue. You also have to find partners that are for funding, not just lending side, which getting bank financing, but I'm saying funding, people who can help you raise capital if you are having a challenge with that. Like if you don't have direct connections with people who can help you raise money, it's going to be very important to have a partner who can help you raise money. And whether they're a partner in the deal or they just get paid a percentage of the money that they raise, there's a bunch of different ways to do this, but you're going to want to make sure you find the right partners across the board here. You don't have to have 100% of the experience, because it's rare that you're going to find that, especially for your first real estate deal. Point number next is devising a plan. So now that you've found the right deal and you have the right partners in place, it's incredibly important to get a plan together. You've found the property. How much is going to be the purchase price? How much work does it need? You're going to create a budget for renovations. How much money do you need to raise in order to close on the deal? What does the financing look like? So that you have to budget for those types of issues, not only for renovations, or budget long-term, where like not only the upfront costs of renovations, but you're going to have to budget long-term, saying, well, the roof is only, maybe it's 15 years old. It doesn't have to be replaced right now, but in 5 years it might have to be replaced. There is a multitude of different things that you're going to want to be budgeting for, which is why you need a plan. And he's saying, okay, well, in this plan, not only am I budgeting for all these things that I've mentioned, but what is my time horizon for owning this property? I want to own the property within the next 10 years. I want to have X amount of the property renovated. I want to have the rents at this point, right? What is the pro forma value? Like, where am I going to try to get my rents to? Because I want to have a goal that within the next 3 years or 8 years, depending on when rates drop, that I'm going to refinance this property at a goal valuation where I can pull out a large percentage of my money that's been invested or my investor's money that has been invested. This way, I'm going to have either a long-term hold or I'm going to end up selling it in 5 years, 7 years, 8 years, 10 years, whatever your plan is, and then I'm going to 1031 exchange that money into a larger property. So you want to get a plan together. What's the whole time, the return on investment that you're going to make. You're going to want to get all these details put together and put it into something called a offering memorandum. You're going to put this into a slide deck so you can present this to either your investors or your partners just to make sure everyone's on the same page of exactly what the game plan is. Now the next step, which again, you can either put this before or after what we just talked about, which is the plan. Sometimes people like to lock up the deal first, and sometimes people want to create the plan first and see which one makes the most sense. I'm a huge fan of making offers 100% of the time as fast as possible. When it says make an offer as the next step, I sometimes have done this 7 steps ago. However, in this instance, I want to say for someone who might be doing their first investment deal, you don't need to make an offer right away. What'll happen is you devise the plan, you understand the details on this property, that you've already run the numbers, you talk to your partners, you've gone through the plan and you've broken everything down. Now you understand exactly where you want to make an offer. Because what happens here is that you're going to do your plan, and then you're going to make an offer based on what your plan was. However, you might not get the deal for the price that you wanted, which is why sometimes you want to do the offer first. But the reason why I'm saying in this instance that you want to run the plan first is so you exactly know what your breaking point is. I can make an offer at, hypothetically, on this 10-unit multifamily property at $2 million and it makes sense. However, if they're asking 2.5 and you offer 2 million and then they say, look, the best number we can do is 2.2, you now can rerun your numbers, go back to your partners, and see if it makes sense on this. And if it doesn't make sense, it's totally fine, but now you've at least run the numbers on this type of deal where if that deal doesn't sell, you know you can always go back to that deal and possibly get it done at $2 million. Make an offer. You can write up a letter of intent. Very easy. It's a non-binding agreement for the most part. Again, talk to your attorneys. Like, I'm not here to be your attorney or your accountant or whoever. Talk to the people you need to be talking with. This is not that type of advice, but I'm a huge fan of making offers on every property as soon as possible. So for those of you who are watching this video and you got a deal on the table, make an offer right away. All you have to do is write up a letter of intent, which is really simply put the address, the buyer and the seller's name, which you can put for your buyer, your LLC. It could be 123 Main Street LLC and or the LLC that is assigned. You're gonna have the seller's name on there, the purchase price, your deposit amount, which just make it within a few percentage points. So hypothetically on a $2 million deal, you might want to do a $10,000 if you're lucky. Most likely be a $25,000 or $50,000 deposit. You put any commission. So if you're a real estate agent, you're going to put on your 4, 5, 6% commission, whatever you want to put on there. Paid by seller to XYZ Realty at closing. And then you're going to have your conditions and terms. So your conditions and terms can be like contingent upon appraisal, contingent upon financing, contingent upon inspections, contingent upon confirmation of leases and all financials. Everything you could possibly imagine, you can put in the contingency section or the term section and just sign it and send it over. It's totally okay. It does not matter what they say because most of the sellers are just going to look at the price. They're looking for $2 million and you gave them $2 million and they could probably care a little bit less than you think about the terms as long as they get their price the majority of the time. Now, there's going to be a percentage where like, what do you mean that it's contingent on financing? I don't want it to be contingent on financing or they're going to give you some BS issues here. But for the most part, it's mostly about price. Don't be afraid to lowball everyone that you possibly can. It's not that big of a deal. And obviously, in this instance, you want to find the best deal possible because what ends up happening most of the time is that people pay too much money for real estate and they end up losing money. But if you pay a great price up front because you make money when you buy, it's very, very hard to lose money in real estate. Now, number next, that you've got the plan together, you've run all the numbers, you made an offer, and they accepted the offer. Fantastic. That's amazing. The next step you're going to have to do here is go through the inspection period and start raising some money for this deal. Now that you got the deal accepted, what's going to happen is you're going to have to put down the deposit amount, which we talked about somewhere between $10,000 and $50,000 on this example. But the large majority of the time, you're going to want to put as little money as possible. I'd say literally every time. You're going to want to put as little money down as possible for a deposit because you're not going to want to just have X amount of money sitting in escrow for X period of time where you're not earning interest on that money. Especially if you have to raise the money because it's going to be a little weird when you have investor money raised just sitting in escrow. It's going to be really interesting. So what we try to do is we try to have the lowest deposit amounts that the sellers are willing to accept. That's why we go in at a very, very low deposit amount and let them counter. And we'll try to work on it that way. But you're going to have to raise money majority of the time unless you're using your own capital. And again, it's just going to be sitting in escrow. So you want to try to negotiate the lowest amount possible. But now that you have a property with an accepted offer, again, congratulations. That's awesome. You're going to have to start raising money. You're going to go through a due diligence period and having your bank review all details. It's incredibly important when you have a lender, the bank who's going to be giving you financing, you're going to want to make sure that they can do the deal. So the very first thing you're going to want to do is get all the leases, all the details around financials, and give it to the bank and say, hey, what type of financing can you give me? This is something that you'd want to make sure you kind of point out very, very, very ahead of time. What's going to happen is they're going to run their numbers and figure out at what percentage to the valuation of this property can they give you a loan. As in an example, they'll give you an 80% LTV, loan to value, or they'll give you a 60% loan to value. So they're going to give you X percent of the valuation of the property when an appraisal is done based off of the income of the property. What happens here is if the property has a very, very low amount of income because it's low rents or whatever reason, it's majorly vacant, whatever it is, the bank's going to give you a pretty low loan to value. However, if the property's making a ton of money, like a crazy amount of money, and for whatever reason the guy wants to get rid of it, because lending is based off of a debt service coverage ratio, a DSCR rate. Most banks at this point are somewhere between 1.2 and 1.3. However, there is a rare occasion that banks are going to be at like a 1 or 1.1, which means that if a property's bringing in $100,000 in net operating income, that means after all expenses that a bank is looking at, a bank will typically want to give you somewhere in the vicinity of like a debt amount, which is like debt payment versus the income of 1.2 to 1.3, which means that the debt total amount, which is like your debt payment, is going to be somewhere between $70,000 and $80,000. You're looking at a loan of somewhere in the vicinity of like $700,000 or $800,000 based off of $100,000 net operating income. It's going to be something you're going to learn all this lingo when you're studying this type of real estate and you're doing a bunch of deals and you're running numbers with the bank. However, it's going to be very, very important. This is why we said we get the right partners. You're going to have these conversations up front during the plan, right? You're creating a plan. You're going to be talking to the bank and saying, okay, what kind of DSCR ratio are you looking at right now? Well, we're looking at a 1.2 or 1.3. And again, if the property has very, very low income, you're going to have to put a lot of money down. That's just what happens. So you make offers very, very low. You have great partners who can get you answers very quickly and they're very attentive and they know what they're doing. This is why we're creating this type of content, okay? So the last thing we're going to talk about is, let's just say that you made the offer, you put down the deposit, you raised all the money, you did the due diligence, and everything looks fantastic. It's time to close. You're going to want to make sure your contractor's ready to go, your property manager's ready to go, and your team is all ready to go so you can close on the deal and rinse, wash, and repeat. Congratulations, you did your first commercial real estate deal. And by the way, if you have any questions on exactly what to look for your first investment property, or any details around investings or anything that we talked about in this video, make sure to put in the comments section down below because I answer each and every single comment. And listen, this process is okay if it takes time. Matter of fact, every real estate deal takes time, and it's okay for your very first deal to be done with partners, and it's okay to try to do it on your own, but just know it's all about how good of a deal you buy, because the better deal you buy, it's harder to lose money in real estate. So other than that, guys, I just want to sign off here. I appreciate you guys watching the video, and I'll see you next time. Take care. If you're still watching this video, that means to me that you're a committed real estate agent, and you're looking to take your life and business to the next level. I'm just curious, why have you yet to schedule your free, no obligation coaching consultation? All you have to do is simply go in the description down below, and people are telling me this call has been the most unbelievable, the most powerful call they've had in their entire career. And here's just a few of the individuals who have taken full advantage of this call. And my mission is to support as many realtors as possible, build a 6- and 7-figure net income business so that they don't have to rely on this industry anymore for their everyday income. If you're a committed realtor, which I can see like you are, all you have to simply do to take full advantage of this free coaching consultation is to go in the description down below and schedule your free call now.